Inflation may no longer be making daily headlines, but the latest data suggests the Federal Reserve's job may not be finished. While inflation has declined significantly from its post-pandemic peak, several key indicators remain above the Fed's long-term objective. The question investors should be asking is simple. Has inflation truly been defeated, or is the final stage of the battle proving more difficult than expected? The Federal Reserve's primary challenge remains balancing its dual mandate of stable prices and healthy employment. That task becomes considerably more complicated when inflation remains stubbornly above target. Today, the most widely followed inflation measures continue to suggest that price pressures have moderated but not disappeared. Let's start with headline inflation. Consumer Price Index inflation currently stands at approximately 4.2%, more than double the Federal Reserve's 2% target. While well below the highs reached in 2022, the recent reacceleration reminds us that inflation often declines unevenly rather than in a straight line. Looking deeper, Core Consumer Price Index, CPI, and Core Personal Consumption Expenditures, PCE, the Federal Reserve's preferred inflation measure, also remain above target. Core PCE currently stands near 3.3%, indicating that underlying inflation pressures continue to persist. Another area worth watching is producer prices. Producer Price Index inflation is currently running near 6.5%, noticeably higher than consumer inflation. Historically, producer prices often influence future consumer prices as businesses attempt to pass higher costs through the economy. The labor market also remains part of the equation. Wage growth has moderated to approximately 3.5%, which currently trails headline inflation. When inflation rises faster than wages, purchasing power can come under pressure, creating challenges for consumers and policymakers alike. Perhaps the most important relationship is between inflation and interest rates. Historically, inflation has often required a federal funds rate that remains above inflation measures for an extended period before price stability is restored. Today, policy remains restrictive, but the margin between short-term interest rates and inflation is relatively narrow. At the same time, the bond market appears cautious. The 2-year Treasury yield remains above the effective federal funds rate, suggesting investors continue to anticipate a Federal Reserve that must remain focused on inflation. The takeaway is not that inflation is spiraling out of control. Rather, the data suggests that inflation's final move toward the Federal Reserve's 2% objective may prove more challenging than the initial decline from peak levels. For investors, this serves as an important reminder that interest rate policy remains heavily dependent on incoming economic data, and that patience often becomes most important when uncertainty remains elevated. We enjoy providing helpful information to help you make sense of markets and important financial planning concepts. Engage LRG Wealth Advisors so we may apply market wisdom to your financial plan and investment portfolios so you may live the life you imagine. This is LaRue Gibson with LRG Wealth Advisors.